Welcome back to Market on Close. I'm Caroline Woods. We have about 10 or 11 minutes left in the trading day. It's time for the big picture. Let's welcome in our guest from Charles Schwab. Joining us now is Collin Martin, Director of Fixed Income Strategist at Schwab Center for Financial Research. Collin, thanks so much for joining us.
Thanks so much for having me.
So, Collin, we haven't hit on bonds at all yet today, so let's get a quick check at the bond market. Seemed like some of the stock sell-off was going into bonds today, although the major averages attempting for a comeback in the final 10 minutes of trading here. What's your take on the action that we've been seeing in the bond market today?
Yeah, for the bonds today, it looks like it was mostly driven by the really disappointing Dallas Fed manufacturing outlook. And as you alluded to, we got a little bit of a rebound with stocks as the day progressed. We haven't really seen that with treasuries, both 2- and 10-year treasuries still pretty much at their lows for the day. What we're seeing, though, is a logical response. And over the past few weeks, we necessarily haven't seen that logical response when bad news pulls yields down. We actually saw that today. The numbers this morning, I mean, granted, it's not one of the key economic indicators that we track. It's more of a soft data for one specific region, but it was really bad. I mean, the headline manufacturing outlook was at its lowest level since, I think, May 2020. That was accompanied with prices paid and prices received indexes moving higher. So that kind of has the theme of stagflation, which has been a theme over the past few weeks. So as the week progresses, we're going to get a lot more hard data. That's what we've been waiting for. We've gotten some disappointing soft data lately. This week is chock full of economic data. So I think we're going to actually see what's been going on with the economy over the past few months as opposed to surveys that are more forward-looking.
Yeah, and these are the final reports that the Fed will get before their interest rate meeting next week. And it's a data-dependent Fed, and we're going to get inflation data and jobs data. So, and we'll also get a read on GDP, but talk to us about your expectations there. Will it be as bad as some of this other data we've been seeing?
That's a really good question, because when we look at a number of GDP real-time indicators, some of them send mixed messages. The one that grabs all the headlines is the Atlanta Fed's GDP now, and that's been really, really weak for most of the first quarter. If you compare that to the New York Fed, they have a GDP nowcast, and it's not as bad. It actually shows growth, pretty close to the trend that we've seen over the past few quarters. So it looks like what the markets are expecting, the consensus estimate, though, is somewhere in the middle. I think 0.3% annualized is the consensus estimate. That would be disappointing, given the recent trend we've seen. We expected a modest slowdown coming into this year, but for most of 2023 and 2024, we were seeing growth in the 2.5% to 3% area, and to come in at just 0.3% would be pretty disappointing, knowing that it could get worse if tariffs remain in place as they've been announced, because we think that has the potential to slow growth even more.
Yeah, but it's not negative. And to your point, it could get worse, and that obviously could point to a recession. But you talk about the stagflation narrative, which would be characterized by high inflation. Do we expect tariff impact to have any impact on the inflationary data yet?
Not yet, but based on some headlines we're seeing, it could be soon. We got the reports out of some of these Chinese companies that they're passing along almost all of the tariffs onto consumers. So it's unlikely that we see a huge impact this week with the PCE report, but I wouldn't be surprised if the April and May numbers, because what we're getting this week is going to be March PCE, the April and May numbers, they might start to creep in there. How these tariffs work their way into inflation, I think is going to be a bit tricky, because how much of the tariffs flow through to the end consumer will depend. It'll depend on how currencies have been moving. It'll depend on how much the importer decides to eat versus pass along. And so I think it can move in a lot of directions, and then add on to the fact that it might just be a one-time price adjustment as opposed to continuous inflation. So how it gets passed through and the potential longevity is going to play into how the Fed reads it. I think what's most important is that inflation has been sticky. I think it'd be a different conversation if inflation was down at 2% and we were getting these tariffs. We're already in an environment where inflation's still too high. Core PCE's been at 2.5% or more for close to 4 years now, still too high. And if we're getting these pressures that even if it's a one-time price increase, it's a price increase nonetheless, and that's a bit discouraging. So I think it's going to be a challenging outlook for the Fed. And as you mentioned, stagflation does pose a risk. I think I have some issues with that because I think the term gets thrown around too much. On the inflation side of the equation, we're still at around 3% or less. So this is not the 70s and 80s stagflation era. And as you mentioned before, with what we're expecting with GDP this week, it's still positive. We haven't seen a negative reading yet. So when we hear about stagflation, I think we need to dial back those expectations a little bit. It's not a dire economic outlook, and it's not inflation at 6, 7, 8% or more levels.
Collin, is there anything in the data that we could get this week that you think could cause the Fed to cut next week? I was taking a look at the CME Fed Watch tool, 91% chance that the Fed remains on hold. But if that, PCE data, which is the Fed's preferred inflation gauge, is, closer to target, if unemployment is higher than expected, could that cause the Fed to cut?
I think it's highly unlikely. Never say never, but we're in line with the market expectations. You're looking at a less than 10% implied probability of a rate cut next week. The Fed does not like to surprise the markets, and I think we would need to see some really, really dire readings this week for them to move. I think it would be less on the inflation front and more on the labor market front. There's so many fears and concerns right now about the potential for the labor market to weaken. We got that from some Fed officials last week. Waller mentioned it, Cleveland Fed President Hammack mentioned it. The idea that if the labor market weakens more than expected, and Hammack specifically said if it was convincing by June they could cut then, you could make the case that if we got a very, very, very bad report this week, meaning for April's numbers, that would likely mean that the following months would probably continue to deteriorate. I just don't think it's going to be that bad. And I think the bar for a cut next week is really, really high. So if we get some bad data this week, whether it's a negative GDP print, whether it's an inflation print that surprises, up or down, or a very, very weak labor market reading, either with JOLTS, initial jobless claims, or Friday's payroll report, I think that's more playing into the June meeting discussion as opposed to next week.
Okay. All right. Yeah. Market wants a rate cut. Can't imagine the market would be happy for a rate cut for that reason. Just quickly, 30 seconds left. What should investors do right now as we kind of await to see where the economy goes, where these trade deals go, and ultimately the impact on the market?
Because there's so much uncertainty, our main guidance is kind of wait and see mode, and not take too much credit risk, not take too much interest rate risk. On the interest rate risk front, we suggest a benchmark average duration. When we talk about benchmark, we're talking about the Bloomberg Ag. It has an average maturity of around 6 years or so. But we caution against investors, our clients at Schwab, from focusing too much on short-term investments, because if you're in very short-term investments like treasury bills or money market funds, you're opening yourself up to reinvestment risk when those rate cuts arrive. And we don't want investors to get caught off guard there. Now, the flip side, if you focus on long-term investments, you're probably going to see a lot of price volatility, potential price declines if yields were to increase. So we'd focus on intermediate term maturities with high quality investments, 4.5%, 5% or more, depending on what the actual maturity is and type of issuer. But we think that's an attractive opportunity, especially compared to where we were in the pre-pandemic area. I mean, these are still yields that are very high, very attractive levels.
Okay. We'll leave it there. Collin Martin, Director, Fixed Income Strategist at Schwab Center for Financial Research.